The yen has been dropping like a rock lately, recently hitting a 34-year low against the dollar. This has major implications for Japan's economy, and we'll be exploring the reasons behind the downward spiral and what it means for Japan's economic future. Let's rewind a bit. To understand the current situation, we need to revisit Japan's recent economic history. After World War II, Japan experienced a period of phenomenal growth known as the Japanese miracle. Imagine this. For decades, Japan's economy grew at an average of 6.8 percentage points per year. This rapid expansion was fueled by factors like a highly skilled workforce, government investment in infrastructure and technology, and a strong export orientation. However, this dream run ended abruptly in the early 1990s with a massive asset bubble burst. Stock and real estate prices had inflated to unsustainable levels, fueled by easy credit and speculative buying. When the bubble finally burst, it triggered a wave of defaults and bankruptcies, plunging Japan into a period of economic stagnation now known as the lost decades. This era was characterized by low growth, deflation, and near-zero interest rates. Faced with deflation, a condition where prices consistently fall, the Bank of Japan implemented some rather unconventional policies to jumpstart the economy. Traditionally, central banks use interest rates as a key tool to influence economic activity. Lowering interest rates makes borrowing cheaper, encouraging businesses to invest and consumers to spend, which can stimulate economic growth. Conversely, raising rates discourages borrowing and spending, aiming to cool down inflation. However, after slashing interest rates as low as they could go, practically 0 percentage points, the BOJ needed additional tools. They embarked on a massive program of quantitative easing, a strategy where they essentially printed new money to buy up enormous quantities of government and corporate debt. This process injects additional money into the financial system, aiming to increase the money supply and boost inflation. The hope was that with more money circulating, people would be more likely to spend, businesses would invest, and economic activity would pick up. While quantitative easing has become a common tool for central banks globally following the 2008 global financial crisis, Japan took it to a whole new level. They now hold the dubious honor of having the world's highest debt-to-GDP ratio, at a staggering 260%. This strategy did manage to prevent deflation, but it also had some unintended consequences. One key impact of ultra-low interest rates and quantitative easing is the effect on incentives. When interest rates are low, it discourages saving. Think about this. Why put your money in a bank account earning minimal interest when you could potentially see higher returns by investing elsewhere? This can lead to a decrease in savings, which can dampen investment and economic growth in the long run. Another consequence is the impact on the exchange rate. The Bank of Japan's ultra-loose monetary policy, compared to stricter policies in other countries, weakened the value of the yen. Remember, currencies are traded just like any other good or service. If demand for a currency increases, its value goes up. Conversely, if demand weakens, its value falls. With other countries raising rates and the BOJ keeping rates low, investors found the yen less attractive, putting downward pressure on its exchange rate. Fast forward to 2022. Inflation started rising worldwide due to factors like supply chain disruptions and the onset of war in Ukraine. Most central banks responded by raising interest rates to combat inflation. However, the BOJ, stuck with its mountain of debt, couldn't follow suit. This created a significant divergence. As other currencies became more attractive with rising rates, the yen weakened considerably. In just a year, it dropped from 130 yen to the dollar to a staggering 34-year low of 160 yen. This weakening yen is a double-edged sword for Japan. On the one hand, it makes Japanese exports cheaper on the global market. Imagine a car company. A weaker yen makes their cars more affordable for foreign buyers, potentially boosting exports and manufacturing. This can be a positive development for companies that rely on exports, leading to increased production, job creation, and overall economic activity in those sectors. However, on the other hand, a weaker yen makes imports more expensive. This can lead to inflation, especially for essential items like food and energy, which are imported into Japan. This situation puts a strain on household budgets, as people have to pay more for everyday necessities. Faced with a weakening yen and rising inflation, the BOJ is in a tight spot. Raising interest rates could be a solution to combat inflation. Higher interest rates make borrowing more expensive, encouraging people to save more and spend less. This reduces demand in the economy, which can help to slow down inflation. However, raising rates could also have negative consequences for Japan's fragile economic recovery. Here's why. Firstly, debt burden. Remember, Japan has a massive debt pile, and even a small increase in interest rates could significantly increase the government's debt servicing costs. This could strain public finances and limit the government's ability to invest in social programs and infrastructure. Next, business investment. Higher borrowing cost could discourage businesses from investing, potentially slowing down economic growth. Companies might delay expansion plans or equipment upgrades if loans become more expensive. Lastly, the stock market. A rise in interest rates could also lead to a decline in stock prices. Investors might shift their money from riskier assets like stocks to safer alternatives like bonds that now offer a higher return with rising interest rates. This could trigger a sell-off in the Japanese stock market. To weaken the downward pressure on the yen, the BOJ recently intervened in the currency market, buying yen with their foreign exchange reserves. This is essentially a way to manipulate the currency's value. By buying yen, they increase demand for it, which can help to stabilize or even strengthen its value. However, this is a costly strategy that can't be sustained forever. Japan's foreign exchange reserves are not limitless. The future of the yen depends on several factors. The first factor, global inflation. If global inflation eases and other central banks start cutting rates, pressure on the yen could lessen. As the interest rate differential between Japan and other countries narrows, the yen could become more attractive to investors, potentially leading to its appreciation. The second factor, BOJ policy. The BOJ's decision on interest rates will be crucial. Will they accept a weaker yen and inflation, or will they risk raising rates and potentially stifling growth? This is a complex dilemma with no easy answers. The third factor, geopolitical events. Global events like the war in Ukraine and ongoing supply chain disruptions can also significantly impact inflation and currency markets. As these situations evolve, they will influence the yen's future trajectory. Japan's economic situation is like a tightrope walk. The BOJ needs to balance on a thin line between boosting exports and keeping inflation in check. Imagine a seesaw. On one end, you have export growth, and on the other, you have inflation. Pushing down on one side lifts the other. A weaker yen makes Japanese exports cheaper on the global market, just like putting a heavier weight on the export side. Think of it like a sale on Japanese cars for foreign buyers, they become more attractive. However, a weaker yen also makes imports more expensive, which is like adding weight to the inflation side. This can lead to rising prices for everyday items like groceries and fuel, squeezing household budgets just like a tightening vice. So, what can the BOJ realistically do? Here are some options. The first option, helping businesses, not just pumping money. Instead of just printing money, the BOJ could target specific businesses that need a boost. Imagine them giving loans or buying bonds from companies that export a lot, like car manufacturers. This provides those companies with easier access to cash to expand their production and sell more cars overseas. The second option, adjusting the interest rate knob carefully. Instead of setting one specific rate, they could set a range like a minimum and maximum. This allows some flexibility for rates to go up slightly if needed to control inflation, while still keeping them low enough for businesses to borrow and invest. The third option, the Yen Intervention Balancing Act. The BOJ can continue to buy yen with their foreign exchange reserves to prop up its value, like stepping on a sinking boat to keep it afloat. This can be helpful in the short term, but it's expensive and not a long-term solution. The future of the Japanese economy is uncertain, influenced by many factors beyond the BOJ's control. However, by considering these options and focusing on targeted support for businesses, flexible interest rate adjustments, and mindful currency intervention, the BOJ can walk this economic tightrope and hopefully steer Japan towards a more stable and prosperous future. What creative solutions can you think of for the BOJ? What would you do if you were in charge? Leave your thoughts in the comments below, and don't forget to like and subscribe for more economics content explained in an easy-to-understand way.